Have you ever wondered why so many traders fail even when they're right about market direction? Picture this. You analyze a stock perfectly, predict its movement with uncanny accuracy, and then somehow still end up losing money. How is that even possible? Today we're diving into what I consider the absolute cornerstone of successful trading. A principle so fundamental yet so often overlooked that it separates the professionals who build lasting wealth from those who flame out in spectacular fashion. Has this ever happened to you? You make a great call on a stock, but still walk away with a loss or minimal profits. The truth about trading isn't what most gurus want you to hear. They'll sell you fancy chart patterns, exclusive indicators, and foolproof entry signals. But what if I told you that none of those things matter if you haven't mastered this one critical rule? Stay with me until the end, because what I'm about to share might completely transform how you approach the markets. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Richard Wyckoff, one of history's greatest market operators, often said, "The market is a place where fortunes are made, not by how often you are right, but by how much you have left after being wrong." This statement holds the key to sustainable success in the markets, and yet it's amazingly simple. Position sizing is everything. Think about it. You could predict market direction correctly 80% of the time and still go broke. Meanwhile, someone else might only be right 40% of the time and steadily build wealth. The difference? How much capital they risk on each trade. What's truly fascinating is how psychological this aspect of trading becomes. When your position is too large, every market fluctuation feels like an emergency. Your heart races with each price tick. Your palms sweat. You can't sleep. You check your phone constantly. Sound familiar? That's not trading. That's torture. What you're about to discover might surprise you, especially if you've been chasing the perfect entry or exit strategy. The hard truth is that proper position sizing transcends all other trading rules. You can have the most sophisticated analysis in the world, but if you bet too much on a single trade, the market will eventually find a way to wipe you out. Consider this scenario. Two traders spot the same opportunity. The first goes all in, risking 50% of their account on this sure thing. The second risks just 2% of their capital. When the market unexpectedly moves against them both, as markets often do, who survives to trade another day? Who maintains the emotional composure to make rational decisions rather than panic-driven mistakes? The principles we're exploring today aren't just theoretical concepts. They're battle-tested survival mechanisms that have protected capital through market crashes, economic collapses, and every type of market condition imaginable. And yet, despite their importance, most traders will go their entire careers without ever mastering this hidden truth. They'll jump from strategy to strategy, indicator to indicator, looking for that magical formula that guarantees success, all while ignoring the very foundation their trading house is built upon. If you found these position sizing insights valuable, hit that subscribe button to join our community of traders who prioritize survival and long-term success over quick profits. Now, I want to go even deeper into this topic by addressing a fundamental mindset shift every successful trader must experience. The market doesn't care about your research. It doesn't care about your clever analysis. It doesn't care that you stayed up until 2 a.m. perfecting your trade plan, and it certainly doesn't care about your financial goals or dreams. This revelation can be jarring when you first truly internalize it. The market owes you absolutely nothing. Yet so many traders approach their positions with an unconscious expectation of reward, as if the market should somehow recognize and compensate them for their effort, intelligence, or conviction. I've witnessed this transformation countless times in traders I've mentored. They enter the market expecting it to validate their ideas, only to discover a cold, impersonal mechanism that will strip away their capital the moment they place it at excessive risk. This is perhaps the most painful journey many traders must undertake, moving from entitlement to acceptance. What's truly fascinating is that the very tool that provides the most protection is often the least discussed among traders. When was the last time you were at a trading conference or in an online forum and heard someone boasting about how cautiously they size their positions? It simply doesn't happen. Nobody brags about the trade they took with just 1% of their capital. Instead, the stories that circulate are about the massive wins, the home runs, the trades where someone went all in and made a killing. This creates a dangerously distorted view of what successful trading actually looks like behind the scenes. The traders who survive decade after decade, who quietly compound their wealth while others flame out, understand that position sizing isn't just a technique, it's their primary shield against market uncertainty. Consider the profound impact proper position sizing had on traders who navigated the 2008 financial crisis or the 2020 pandemic crash. Those who survived didn't do so because they predicted these events. Many didn't. They survived because they never put themselves in a position where being wrong would destroy them. Their decisions around position sizing created a buffer that allowed them to weather even the most severe market storms. The real secret that veteran traders understand is that consistent profitability isn't about avoiding losses. It's about ensuring those losses never threaten your survival. When you size your positions appropriately, you create the space to learn, adjust, and grow from your mistakes rather than being eliminated by them. If you're finding yourself nodding along to this, type protection first in the comments below. I'm curious how many of you have already discovered this principle in your own trading journey. Let me share a powerful revelation I've witnessed countless times in my trading journey. Picture two traders looking at exactly the same chart, with the same setup, same entry price, same target. The only difference, one has 50% of their account in this single trade, the other has 2%. When that first pullback hits, these two traders might as well be living in entirely different realities. The psychological dimension of position sizing is perhaps its most profound yet least appreciated aspect. You see, being right about market direction becomes almost irrelevant if your position size creates such intense emotional pressure that you can't execute your plan. This mindset shift completely transforms how we should approach the markets. Consider what happens physiologically when you're in an oversized position. Your cortisol levels spike, your breathing becomes shallow, your decision-making literally migrates from your prefrontal cortex, the rational part of your brain, to your amygdala, your fight-or-flight center. The scientific truth is that you're physically incapable of making optimal decisions in this state. This isn't about willpower or discipline. It's basic neuroscience. What's particularly fascinating is the illusion many newcomers operate under. They perform a simple calculation. If I double my position size, I'll double my profits. This arithmetic seems logical on the surface, but it completely ignores the hidden psychological tax that comes with larger positions. What they don't realize is they're not just doubling potential profits. They're exponentially increasing pressure, anxiety, and the likelihood of emotional decision-making. I remember working with a trader, brilliant analyst, consistently identified great setups, who kept sabotaging himself with premature exits. No amount of technical education helped until we cut his position sizes by 75%. The transformation was immediate. Suddenly, he could hold through normal market fluctuations that previously sent him into panic. His win rate barely changed, but his average profit per trade tripled simply because he could now stick to his original plan. This journey toward proper position sizing often requires a complete reimagining of what trading success looks like. The market requires patience, the ability to sit quietly through volatility, to endure the natural ebbs and flows without overreacting. But patience isn't just a character trait you either have or don't. It's a capacity that expands or contracts depending on the pressure you're under. With appropriate position sizing, patience becomes possible. With oversized positions, it becomes virtually impossible. If this perspective on position sizing resonated with you, give this video a quick like. It helps these more nuanced trading conversations reach others who need to hear them. What's truly enlightening is realizing that trading is far more psychological than technical. Your beautiful chart patterns, indicators, and analysis mean nothing if your position size prevents you from executing with clarity and calm. Your brain literally functions differently when you're properly sized versus when you're overextended. One state leads to rational decisions, the other to fight or flight reactions. This perspective completely reframes how we should approach improvement as traders. If you've been struggling with impulsive entries or premature exits, type "right-sizing my mindset" in the comments. If you're starting to see how position sizing might be the underlying issue rather than your technical analysis skills. Let's explore a profound distinction that completely reshapes how we understand the market ecosystem. There's a fundamental transformation that occurs when a trader crosses an invisible threshold with their position sizing. They cease being a speculator and become a gambler. This revelation might sound subtle, but the implications are enormous. Think about what defines a speculator versus a gambler. A speculator enters positions when the odds favor a particular outcome. They're calculated, measured, and most importantly, they have the freedom to wait for favorable conditions. A gambler, on the other hand, places bets because they feel compelled to, driven by necessity, desperation, or emotional impulse rather than mathematical edge. The fascinating insight here is that this distinction isn't about your strategy or analysis. It's almost entirely determined by your position size. When you're properly sized, you remain a speculator, making decisions based on probability and edge. But the moment your position grows too large relative to your capital, your mindset undergoes a radical shift. Suddenly, every market movement becomes life or death. Your decision-making becomes clouded by fear, hope, and desperation, the hallmarks of gambling rather than calculated speculation. I've witnessed this journey countless times. Behind the scenes with traders who couldn't understand why their decision-making deteriorated so dramatically on larger positions. The same person who could rationally manage a small trade would become completely unrecognizable when the stakes were raised. This wasn't a character flaw, it was a natural consequence of improper position sizing. What's particularly eye-opening is understanding how the market treats these two types of participants. The market has a unique ability to expose any weakness in your approach. It's an environment completely devoid of forgiveness, especially for those who size improperly. This truth can be harsh yet liberating. It's not your knowledge, courage, or secret tips that ultimately save you in the markets. It's your position sizing. Consider the wisdom in this perspective shift. A small position allows for corrections. If you're wrong, you can adjust. A small loss can be endured without catastrophic consequences. A small mistake becomes a valuable lesson rather than a career-ending blow. This creates space for growth and development, but when your position size crosses that critical threshold, the market offers no mercy, no second chances, no room for error. Richard Wyckoff recognized this reality decades ago when he observed that the market doesn't punish you for being wrong. It punishes you for being wrong with too much at stake. This insight completely reframes how we should approach risk. The goal isn't to avoid being wrong. That's impossible. The goal is to ensure that being wrong never threatens your survival in the game. What's truly eye-opening is realizing that many traders unconsciously set themselves up for failure before they even place a trade, simply through improper position sizing. If something about this perspective has clicked for you, type "speculator gambler" in the comments to let me know you're seeing trading through this crucial lens. Now I want to explore what might be the most fundamental psychological barrier preventing traders from adopting proper position sizing: impatience. There's a profound mindset challenge that virtually every trader confronts on their journey. We live in a culture that celebrates overnight success stories and viral sensations. This collective mythology has infiltrated trading psychology in a particularly destructive way. Most traders simply cannot stand the idea of thinking small. They dream of life-changing wealth without embracing the transformation required to build it. There's a deep resistance to accepting that sustainable success in the markets typically unfolds over years, not days or weeks. This impatience manifests itself most dangerously in position sizing. I've had countless conversations with traders who intellectually understand the principles of risk management, yet emotionally reject them. Why risk only 1% per trade when I could risk 10% and grow my account 10 times faster? This reasoning seems logical on the surface, but it fundamentally misunderstands the non-linear nature of risk. The hidden truth is that taking large positions is immediately wrong, regardless of whether the stock moves in your favor. Why? Because oversized positions prevent the calm, rational management necessary for consistent profitability. What's particularly illuminating is examining the journey of trading legends who had to learn this lesson through painful experience. Richard Wyckoff, whose trading wisdom has influenced generations, provides perhaps the most powerful cautionary tale. Despite being a brilliant market analyst with exceptional understanding of market mechanisms, Wyckoff experienced devastating losses early in his career. The remarkable revelation in Wyckoff's story is that he went broke despite being right about market direction, timing, and his analysis. This paradox confounds many traders. How can someone be correct about a trade and still lose everything? The answer lies entirely in position sizing. His positions were simply too large. When the market briefly turned against him, as markets inevitably do, even during correct predictions, he was forced to liquidate at precisely the wrong moment. This powerful insight completely reframes how we should think about trading losses. Wyckoff didn't go broke because he was wrong. He went broke because his position size didn't allow him to be right. When you're over-leveraged, even minor temporary market fluctuations can force you out of positions that would ultimately have been profitable if you could have weathered the storm. What makes this lesson so universal is that nearly every successful trader has a similar chapter in their personal journey. The markets have a way of teaching this principle with particular clarity and often significant personal cost. I've never met a consistently profitable trader who didn't have their own version of this story. A painful experience where being right about market direction still resulted in losses because of improper position sizing. If you've experienced your own version of this revelation, a trade where you were right about direction but still lost money because your position size created unbearable pressure, type "sized out of being right" in the comments. These shared experiences often illuminate the most profound market truths. Let me share a remarkably simple yet powerful litmus test for proper position sizing that has guided traders through market cycles for generations. What I call the sleep test. This intuitive barometer cuts through the complexity of mathematical formulas and brings position sizing back to its psychological essence. Your position should always be small enough that you can sleep soundly at night. That's it. This revelation might seem almost too simple, but its wisdom runs deep. Don't miss out on more trading wisdom like this. Subscribe now to access the kind of market insights that took me years of painful lessons to discover. Consider the behavioral signs that your position size has crossed the threshold into dangerous territory. If you find yourself waking up at 3 a.m. to check futures markets, your size is too large. If you can't tear your eyes away from price movements during the trading day, constantly refreshing your screen, your size is too large. If you feel a sense of dread about leaving your computer unattended for even an hour, your size is too large. This transformation in perspective puts the focus where it belongs, not on complex formulas, but on your own psychological comfort level. What's fascinating is that proper position sizing creates a kind of liberation. When you're appropriately sized, the market no longer controls your emotional state or your daily life. You regain sovereignty over your attention and peace of mind. The wisdom of this approach reveals itself most clearly during market volatility. A trader who passes the sleep test can maintain clarity and objectivity during turbulent conditions, precisely because they're not overwhelmed by the potential impact of market movements on their financial well-being. This creates a virtuous cycle where emotional stability leads to better decisions, which in turn generates better results. Now let's explore another dimension where position sizing often goes awry: the practice of pyramiding, or adding to winning positions. This strategy, when executed properly, can be incredibly powerful. But the hidden truth is that most traders implement it in a way that dramatically increases risk rather than managing it. The common mistake occurs when traders experience initial success. A position moves in their favor, and suddenly they're filled with confidence, often overconfidence. They rush to double or triple their exposure, not out of calculated strategy, but from emotional exuberance. What makes this pattern particularly dangerous is that it feels justified precisely when it's most risky. The disciplined approach to pyramiding represents a completely different mindset. It requires letting the market finance your increased exposure rather than using additional original capital. In other words, you only add to positions using profits that the market has already given you. This creates a natural buffer that protects your core capital while still allowing for amplified returns on successful trades. This approach demands remarkable patience and emotional regulation, qualities that emerge naturally from proper position sizing. When your initial position is appropriately sized, you can make pyramiding decisions from a place of strategic calculation rather than emotional impulse. If you've recognized any of these warning signs in your own trading, difficulty sleeping, constant price checking, or impulsive pyramiding, type right sizing for sanity in the comments. This awareness is often the first step toward trading transformation. One of the most eye-opening revelations in market history is studying the legendary traders who took seemingly massive positions. Behind the scenes of these bold market operations lies a counterintuitive truth. These weren't reckless gamblers, but methodical risk managers whose boldness was precisely calculated. Many aspiring traders misinterpret these historical examples, confusing audacity with recklessness. Take a moment to consider the great market operators of the past century. What's fascinating is that despite their reputation for aggressive trading, these legends lived and died by their position sizing discipline. They could take large absolute positions, not because they were more courageous than everyone else, but because they had built the capital base to support those positions, while maintaining proportional risk. This profound insight completely transforms how we should view market legends. The hidden truth behind their success wasn't extraordinary courage. It was extraordinary discipline. When you examine their operations closely, you discover their positions were always controlled relative to their capital. They never confused boldness with recklessness. This mindset shift is crucial for any trader seeking sustainability. True trading courage isn't about risking everything on a conviction. It's about having the discipline to size appropriately, regardless of how strong that conviction feels. What's particularly revealing is understanding what happens behind the market facade. While the crowd sees only the flashy trades and spectacular wins, the professionals understand that trading mastery is primarily about survival. This brings us to perhaps the most profound market insight. The trader who makes a killing isn't the one with the best strategy or analysis. It's simply the one who has survived long enough to be present when the big move comes. This perspective completely reorients how we should approach the markets. Every significant price move that created a market fortune was first preceded by small moves that tested patience. These preliminary moves shake out the oversized traders through fear, margin calls, or psychological pressure. Only those whose position sizing allowed them to hold through these tests remained to capture the real move when it finally arrived. Drop a like on this video if you've experienced the power of proper position sizing in your own trading. Your support helps spread these critical market principles. Consider the journey of any significant market trend. It doesn't move in a straight line. It climbs a wall of worry, frequently testing the resolve of those positioned for it. These tests aren't random. They're a natural part of market psychology and order flow dynamics. The market has a remarkable way of finding precisely the price levels that force out the maximum number of traders before the real move begins. I've witnessed countless scenarios where traders correctly identified a major trend early, entered positions, but were forced out by normal market fluctuations before the significant move occurred. The tragic irony is that their analysis was completely correct. They just couldn't survive the journey because their position size created unbearable pressure during inevitable market tests. This revelation transforms how we should view trading success. The ability to capture major market moves isn't primarily about analysis or timing. It's about sizing positions appropriately so you can withstand the psychological and financial tests that always precede significant price movements. Your position size determines whether you'll still be in the game when the real opportunity unfolds. If you've ever experienced the frustration of being forced out of a position that later proved correct, type "survive to thrive" in the comments. This shared experience often contains the most valuable market lessons. Now I want to address one of the most dangerous traps that ensnares traders who violate proper position sizing principles: the temptation to average down on losing trades. This psychological pitfall reveals the cascading consequences that follow from an initial sizing error. The illuminating insight here is how one mistake in position sizing often leads to a series of increasingly destructive decisions. Consider the stark contrast in mindset between two different traders. A trader who begins with a properly sized position maintains decision-making flexibility. When the market moves against their thesis, they can objectively reassess, cut losses if necessary, and move on to the next opportunity without significant damage to their capital or psychology. This creates freedom and clarity that leads to better future decisions. But the transformation that occurs with the trader who starts too large is remarkable. When their oversized position moves against them, they face an excruciating dilemma. Accepting the loss would be painful because of its relative size to their account. This creates a powerful psychological incentive to avoid realizing that loss. The mind begins searching for justification, and averaging down presents itself as a seductive solution. What's particularly insidious about this pattern is how it disguises increasing risk as responsible management. The trader buys more as prices fall, telling themselves they're lowering their average cost basis or getting a better deal on something they already believed in. But what they're actually doing is dramatically amplifying risk at precisely the moment the market is signaling their initial analysis may be flawed. This journey into the psychological labyrinth of averaging down reveals perhaps the most profound truth about position sizing. Ultimately, size controls the trader, not vice versa. This revelation completely inverts how most people understand the relationship between themselves and their positions. When your position is too large, a fascinating psychological imprisonment occurs. Your market opinion becomes your cage. You cannot change your mind or adapt to new information because the cost of doing so has become prohibitively high. You tell yourself you're demonstrating conviction or patience, but in reality, you're experiencing paralysis. You're not holding because you believe in your analysis. You're holding because you cannot bear the consequences of being wrong. The market has an uncanny ability to detect and exploit this vulnerability. It seems almost designed to break those who cannot admit mistakes quickly and move on. The paradox is that what appears outwardly as strength, holding through adversity, is often actually profound weakness when it stems from oversized positions. True market strength comes not from stubborn adherence to positions, but from the comfort of knowing that if the market proves you wrong, you can accept the loss and continue trading. This liberation only comes from position sizing that allows for error without catastrophe. It creates the psychological freedom to adapt, evolve, and ultimately succeed. If something about this psychological dynamic resonates with your trading experience, type "freedom through sizing" in the comments. I'm curious how many of you have recognized these patterns in your own decision-making. As we wrap up today's exploration of position sizing, I want to thank you for taking this journey with me. The principles we've discussed aren't just theoretical concepts. They're the foundation of sustainable trading success that I've seen transform countless trading careers, including my own. If you found value in these insights about position sizing and trading psychology, consider subscribing to the channel. I share these hard-earned market truths each week, not the flashy strategies that come and go, but the timeless principles that have sustained successful traders through every market cycle. It's always fascinating to see who resonates deeply with these more psychological aspects of trading. If something in today's video struck a chord with you, leave a comment saying size determines survival. I'd love to connect with those of you who truly understand the profound importance of this principle. And if you found this perspective helpful, a simple like lets me know these deeper trading insights are valuable to you. It helps others discover this conversation as well. I've prepared a video right here that builds on what we've discussed today. It explores how to practically implement these position sizing principles across different market conditions. Click and join me there to continue developing this crucial aspect of your trading foundation. Remember, in trading as in life, it's not about avoiding mistakes. It's about ensuring no single mistake can break you. That's the true power of proper position sizing.